In this video, we're going to introduce the whole concept of valuation. Let's get into it. Imagine that you own a business which generates a substantial amount of revenue every single year. The specific amount of revenue could be whatever you fancy, but it's a good idea to just think about some number or some amount of revenue that your amazing business generates. If I was to ask you how much you want to sell this business for, what would you tell me? It's a good idea to pause the video right now and just think about how much you would sell this business for. And if you do actually own a business, then it's certainly worth thinking about how much you would want to sell it for right now. Alright, hopefully you did that. Now what I'd like you to do is imagine that the business still does generate a substantial amount of revenue every year, but it's not you that owns the business, it's someone else, and you're not looking to sell it, you're looking to buy it. So take the time to think about how much you would be willing to buy this business for. Chances are, the amount you're looking to buy it for is lesser than, or perhaps substantially lesser than, the amount you're looking to sell it for. And this is the point. This is the bottom line. Valuation is a story. There's no such thing as a true or correct value, despite what anyone in the entire world may tell you. You see, valuation is subjective. It's context and preference dependent. And you literally hopefully saw this just now when I asked you to consider how much you would sell a business for versus how much you would pay to buy it. And so just like you, sellers will tend to value their businesses higher than buyers of the same assets. And the resulting purchase or sale value is a function of which story is more believable, right? So whose value or whose price estimate sounds more plausible, sounds more reasonable, and sounds more believable. And of course, on the subject of believability, it's likely a function of reasonability and need. So for example, if for whatever reason you desperately need to sell your business or your asset, you'll likely get a pretty raw deal. If on the other hand, you have ample time and can get a variety of different prospective buyers, you'll likely get a much better deal. But that's just one tiny example. In the broader sense, we tend to use numbers, equations, and logic to determine the believability and reasonability of the story we're considering. And the way we interpret this is to say, well, if the price of the asset is higher than what the story suggests, then we say the asset is overvalued. If, on the other hand, the price of the asset is lower than what the story suggests, then we think we're getting a good deal because the asset, according to us, is undervalued. And of course, if the price of the asset is equal to what the story suggests, then we think that the asset is fairly priced. Now, we define the value based on the story as what we call the intrinsic value or the intrinsic price. And this is basically what we think the business should be trading at, or what the business should be worth, or what it should be valued at. This can be equal to the market price, but it doesn't necessarily need to be. And we determine whether an asset is under or overvalued by essentially comparing this intrinsic value, this value based on the story, with that of the market price. But if we think about the valuation models themselves, well, the models can be as simple or as complicated as we like. And what you'll find, especially during the early stages of your journey to mastering finance, is that it's easy, and indeed oftentimes tempting, to make models look sophisticated and complex. And it's mainly because these sophisticated models just look a lot cooler and, make us look really clever and intelligent. But it really can't be stressed enough that simplicity is the ultimate sophistication. Because the more you progress on, the more likely you'll see that most, if not all the times, the simple models tend to outperform, or at least do as well as the more complicated models. On a final note, before we close off, I just want to make sure we're all on the same page as far as the purpose of any valuation exercise goes, or rather, the justification of doing this whole exercise. You see, if markets are what we call efficient, then there's no need to value any asset manually. And that is because the value of every asset would be determined by the market, and it's easily accessible and viewable by everyone. Now, this part is actually true, right? So we can see the value of assets or the prices of assets, at least for publicly listed companies, on the open market, right? So when you look at a stock price, that is essentially a function of the value, right? So you are seeing the value right there. The question is whether you think that value is right. And the moment you start questioning whether it is correct, then you're essentially saying that you do not believe in efficient markets. So by attempting to value any stock, by considering valuing a stock, by picking up a calculator to value a stock, or opening an Excel or Google spreadsheet to value a stock, you essentially imply that you do not believe markets are efficient. Because if you did believe markets are efficient, then there's absolutely no point to, carry out a valuation manually. You would just need to look up the value of a stock on Yahoo Finance or Google Finance or anywhere else that, shows you the price or value of a stock, and that would be the end of the story. While we might argue and debate for days on end, if not, months and years, whether or not the market is actually efficient, I think we can all agree that when it comes to valuation, we're looking for some relevance and reliability, right? So we want our valuation estimates to be relevant and reliable. The thing is, as you saw at the start of this video, when I asked you to consider how much you would sell your business for and then later how much you would buy it for, there is some subjectivity involved. And that's not necessarily a bad thing. Because on the one hand, if we think about the reliability of estimates, then as the subjectivity increases, I think we'd all agree that the reliability would decrease. So if we were to plot out the reliability of estimates with the subjectivity involved, I think we'd agree that we'd see a downward sloping line. So the lower the subjectivity, the higher the reliability, and the higher the subjectivity, the lower the reliability. But if we were to plot out relevance of estimates with subjectivity, we'd likely have an upward sloping line up to a certain point, after which, things go into la la land or cloud cuckoo land. And so really the whole point is that when you're trying to value an asset, any asset, there will inevitably be some level of subjectivity involved. What we want to do is not necessarily minimize the subjectivity, but certainly have it at a sort of optimum level. We essentially want to find the sweet spot where both relevance and reliability are maximized. And that is precisely what we're going to work towards achieving throughout this course, and it's precisely what I hope and believe you'll be able to do by the end of this course. Alright, in summary then, we learned that valuation ultimately is a story. We learned that there's no such thing as a true or perfectly correct valuation, and that we compare our estimates of value with a market price to determine whether an asset is undervalued, overvalued, or indeed fairly priced or fairly valued. Importantly, conducting any sort of valuation, however small, large, complicated, or simple, implies a belief that markets are not entirely efficient. Alright, that's enough from me for now. Have a go at the quiz, and I'll see you in the next video.